Good morning, good afternoon, good evening, and welcome to Martyn Lucas Investor. It's time for SoFi earnings coming up in just 13 minutes from now. We are early, of course. We like to be early, but we're ready to rock and roll. We're ready to go. Welcome everybody into the show, and hope you're all well on this fine morning. SoFi earnings. So let's get ready. We've got the chart. We've got everything that we need up and running, and we're looking good. All right, we're looking good. So let me just bring it up on the screen for you now. We're going to share with you this screen here, a close-up of the price. We're also going to look at the advanced chart, and we've got the SoFi results there as well. All of this coming up for you in a couple of minutes. So we're ready to rock and roll. Welcome to the SoFi earnings. If it's your first time, please click subscribe, ring the bell, and tap the like button. We was asked to cover this earnings by one of our members, and they gave a minimum of $5 super chat, which is all it takes, and that's all I ask to cover it, and I did, and here we are up bright and early in the morning covering the SoFi earnings. So what we're going to do now is we've got a few polls running. Let me just repost that one. There is, will it beat or miss? Well, it met expectations. That is the actual result of this. Repost that. And if I quote this one live now, join us. Okay, let me just put that there. So it is SOFI, and we're off and running. SOFI. Excellent. Let me repost that. All right, that's right to the top. We're good to go. SoFi earnings. We're live right now. That's good. Make sure all the links are good. And yes, they are. So we're all ready to rock and roll. We've got lots of notifications here on X. Let me have a quick look at what's been shared here. With lots of sharing. Elon Musk. Terry Reid just followed me. Thank you very much indeed. A lot of reposts. Tilray. Wow, a lot of reposts. 9 new followers last night. Let me acknowledge all of you. We've got Deb. We've got Akin. We've got The Raging Gun. We've also got Dustin Wallace. Thank you, Dustin Wallace. And Hunden Rufus, George, Radislav, and Jonathan, Bastian, and Good AM. Thank you very much indeed to all of you who followed me last night after the Tilray earnings. But now we've got SoFi earnings, and away we go. Come into the chat. Let me know you're here. I'd love to hear from you. That'd be great. We've got 10 minutes to go, so we are early. Always early. We've got a few new members that want to join Discord, so let me light that up. Let me just do that now. Okay, if you do join Discord, this is how you do it. Let me give you the link right now. Look at that. It's done it again. Every morning I wake up and for some reason Discord, my Stream Deck has to be reset. It's really, really weird. I don't know why. This didn't used to happen. Okay. Right, I've done it anyway. So, all right, let's try it again. There, works there now. Really, really weird why I've got to do that every morning. But anyway, I've got to do it, so there it is. There's Discord if you want to join Discord, but you need to be a YouTube member, or you can be a YouTube Discord subscriber, whichever way you like. But let me just welcome in a few members while we're waiting. SoFi earnings, we are just a few minutes away. No, we're up to date there. That's good, we're up to date. Date there. Welcome everybody on the extra channel. Good morning to all of you. James 007, thank you very much for being in there. SoFi earnings, we're just 10 minutes ago. Welcome to all of you. If you want to vote on my poll on X, we are running a poll. Let me share with you the X link. There's the X link in the chat for you. This is the question we're asking you. Is it a buy? Is SoFi a buy, hold, or sell for you? 35 votes saying buy. Sorry, I beg your pardon. Yeah, 35 votes, 74.3%. If you want to go and change that, you've still got time to change that vote, that poll. Is it a beat? No, it's not a beat at all. It's they've met expectations. So I'm not surprised by this, but then anyway, there's some met expectations. If you want to comment on that, are you satisfied with that? I wouldn't be. We should expect excellence from our investments. We're not getting that from SoFi at the moment. Ever since the CEO lied about the interest rates, I think he's lost credibility. That's partly the issue here. But anyway, we shall see how it goes out on today's earnings. I've covered every one of these. So I'd like to hear what he has to say. Anyway, good morning, Martin. I've just been in TikTok. Oh, have you? Thank you very much indeed. Yes, we're live on TikTok right now. Hello, everybody. If you want a special welcome, TikTokers, you can have a special welcome. What you do is click the profile here. You'll find our YouTube link. You come out of the main, you come out of your live show on TikTok. You'll find the YouTube link. Come on in. If you come into YouTube chat and say, hi, I'm from TikTok, you'll get a great welcome from all our members. All right. So if you want to, oh, there's James on the screen now. Look, he's promoting TikTok. Thank you, James. Look at that. Absolutely great. Awesome, mate. All right, let's get back to it. 7 minutes to go. Let's zoom on in and make sure we've got everything up and running. I'm surprised it's so quiet this morning. I thought we'd get much bigger numbers than this. We've had nearly 1,000 people see the pre video, so I'm surprised. I was hoping we'd get like maybe 300 or 400 during the live stream, maybe 1,000. So there's Q2 24 summary results. We're about to start. We've got a couple of minutes to go. There's the audio coming through. I'm just checking the sound quality. All good. And there we go. We're all looking good. SoFi is up at the moment. All right. SoFi YouTube game show. It says SoFi. Okay. 5 minutes to go. Let's have a quick listen in to news. Have we got anything? Fed lowering rates. Let's have a listen in.
Long term, to keep economic activity running at a rate, importantly, that is conducive to 2% inflation. It's not clear to me that that rate is substantially higher than where it was before the pandemic. I would say I agree with your previous guest. Rates are very high. It's clear to me that when I look at the credit creation data coming from the Federal Reserve itself,
okay, we're just listening in. This is important for SoFi.
I'm completely on the same page as Chair Powell.
5 minutes to go
Vice Chair
before SoFi
of the
earnings.
FOMC, John Williams. They think policy is restrictive. Based on the data that I'm looking at, I completely agree with them.
Based on your assumptions, where's the US dollar? You know, politics and all of this is hard to predict, but what about the foreign exchange market? Where does that fit in?
Yeah, well, okay, you start with an easy market there, the foreign exchange market. What I would say is this, you know, we have been biased long the dollar in our
just 4 minutes to go. Blue Boy, thank you very much indeed. We'll leave that for a moment. We'll just go back to SoFi's information on the screen and see if we've got... it won't start early, they never do. Always 1 or 2 minutes late, but that's typical of all earnings. SoFi, there it is. There's the chart. There's the presentation. That's what we're looking at. If you've just tuned in, click subscribe, ring the bell. We want to get 100 likes for YouTube to suggest this video and promote SoFi. So if you want SoFi to be talked about, let me just check how we rank for SoFi. We rank #1 in the world for Tilray. We covered Tilray last night. Let's see how we rank for SoFi. Incognito mode, of course. We're not going to cheat. SOFI stock. Let's see how we rank for that. I doubt if we rank very high for this one. We don't do it very much. Let's have a look. No, I'm not currently ranking for this one. I might by the end of the day if I do a few videos today, but not at the moment. Right, we've got 4 minutes to go. Welcome, everybody. SoFi, just 3 minutes to go now. Back coffee made, says Stephen. Thank you for covering the earnings, Martyn. I'm not in SoFi, but I like to listen to the earnings. James 007, thank you so much indeed. It's very, very important to listen to earnings. You learn about the economy. We also, I tell you what we do want to quickly look at, P&G. This is why the markets are up today, in case you're wondering why the markets are up today. We've had 78% so far of the S&P 500 report. 78% of the S&P that has reported has beaten earnings. So yes, we've got Procter & Gamble have beaten earnings as well. Estimated 30, they've come in at 31. So they've beaten earnings as well. This is good. This is really good if you were like me, believing that the markets were going to go up after all these earnings. Microsoft tonight will set everything. So Microsoft is the key. That's tonight. Anyway, we've got just 1.5 minutes to go for the SoFi earnings. If you've just tuned in, good morning and welcome to all of you. What made you choose YouTube as your preferred platform, Martyn? Well, that's a no-brainer. Google and YouTube are the biggest search engines in the world. They're not going anywhere. They're not fads like TikTok comes and goes and other things comes and goes. You can't earn any money on Facebook at all. Instagram, I don't get any money from Instagram. I earn pennies a month on TikTok. I earn 50 cents a day on Rumble. Again, Rumble is nowhere near Google and YouTube. I mean, the scale is insane. It's worth, thank you very much, Leah. It's worth being in all of these places. But YouTube, without a question, is that the preferred professional medium for all TV. It's mainstream TV now. YouTube TV is replacing regular cable TV. No other platform's going to do that, are they? Thank you, Leah, for my tea. Cheers, James. I haven't got time for our normal morning spotlight tea, but we've got the SoFi earnings to start with. Here we go. Really surprised. I thought we'd have maybe 1,000 people in this morning. Been kind of strange. Don't know why we got so few. Never mind. Anyway, SoFi earnings. Let me listen in. Okay, they're playing music. Let me check that one as well. Okay. Here we go. SoFi earnings just moments away. Thank you, James. SoFi earnings, if you just tuned in, click subscribe and ring the bell. This will go out as its own video later as well. Smash the like button. SoFi just jumped up. Oh, it's jumped. SoFi has just jumped. It was green and green, red. People scalping that. In and out really quickly. Okay, let's go back again. Let's check they're started yet. No, not started yet. Normally 1 or 2 minutes late is quite normal. SoFi earnings, if you just tuned in, welcome to you. Here we go.
We'll begin in approximately 2 minutes' time. Thank you for your patience.
Very, very nice indeed. Very, very impressed. Very impressed with SoFi there. They came on just a few moments after the time and said, we're going to be another couple of minutes. I've never heard that before. Very, very nice. Very, very commendable. People don't do that. They just go late. And I've always found it quite rude when you think that your investors are tuned in and you just come late. Never a word about being late or anything. They just go late. I think that was really, really good for SoFi to say that we're going to be late. That never happens. Kudos to them. I mean, literally, that never happens. They just go late and go, well, we're late. I've always found it quite arrogant, but there you go. That was very, very good. Okay, so we'll probably wait, and it'll be another minute then. Now they've said it's 2 minutes. We should be good. Let's listen in. They're just playing audio. I keep muting it. Good morning, James. We've got two James this morning, James 007 and James, a guest. Okay, we're listening in. Hasn't started yet. Welcome to all of you. Here's our live show. Tap the like button. If we get to 100 likes, YouTube will suggest this out and more people will be made aware of SoFi. Okay, moments to go. I'm listening in, keeping you updated. Thank you ever so much, everybody on TikTok. Hello from Romania. Romania. Wonderful. We've got a lot of, not a lot, we've got a couple of Romanians in our YouTube show. Join us now. Here we go.
All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by 1 on your telephone keypad. If you wish to withdraw your question, please press star followed by 2. Thank you. With that, you may begin your conference.
Thank you, and good morning. Welcome to SoFi's second quarter of 2024 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the Investor Relations section of our website. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now, I'd like to turn the call over to Anthony.
Thank you, and good morning, everyone. Our second quarter results were exceptional and continue to demonstrate SoFi's leadership as a one-stop shop for digital financial services and the amazing grit of our team. I'll cover 5 topics before turning to Chris for a deeper look at our financial and operating performance. First, our strategy continues to drive strong, diversified growth, profitability, and returns. Second, our continuous product innovation and brand building are fueling significant member and product growth, which are key to our long-term revenue and profit growth outlooks. Third, turning to our segment results, our financial services segment demonstrates our clear structural advantages in delivering value to members. Fourth, our leadership and agility in lending has generated sustained returns despite rising rates and positions us to move quickly once rates come down. And finally, our tech platform is making good progress on its journey toward becoming the AWS of not only fintech, but of financial services broadly. Turning to the first topic, the success of our one-stop shop strategy. For Q2, adjusted net revenue reached a new record of $597 million, a 22% year-over-year increase. Our rapid diversification made a record revenue quarter possible, even with just 5% growth in adjusted net revenue in lending. Combined, financial services and tech platform revenue grew 46% year-over-year and now makes up 45% of total adjusted net revenue, up from 38% 1 year ago. To put that accomplishment in context, lending now stands at just 57% of adjusted net revenue compared to 99% of our revenue when I joined nearly 7 years ago, and more than 70% of revenue just 2 years ago. We also delivered even greater growth and profitability in the quarter. EBITDA grew 80% year-over-year to $138 million. We recorded our third consecutive quarter of GAAP profitability with $17 million in GAAP net income versus a loss of $40 million in Q2 of 2023. Credit performance was better than expected as cumulative fair value adjustments from delinquent loans peaked in March, along with delinquencies on an absolute and percentage basis. We are really encouraged by our team's ability to bend the curves through stringent underwriting, limiting credit exposure when prudent, and improving collections and servicing. Chris will share details on the performance of our recent personal loan vintages, which show clear improvements versus older vintages, underscoring our confidence in our prior guidance around life of loan losses peaking in the 7 to 8% range. Our loan sales continue to scale at attractive execution levels with an increasingly diversified set of buyers, with $1.6 billion in total sales this quarter and $4.7 billion in the 3 trailing quarters. This brings me to my second topic. Our rapid pace of innovation and brand building are fueling significant member and product growth. The growing size of our member base and the number of products they use
Show donated
impact the results we're reporting today.
$4.99 through a super chat.
But more importantly, they are the leading indicators of our potential revenue growth and profitability in the future. In Q2, we added 643,000 members and now have 8.8 million in total. That's up 41% year over year. We grew products in the quarter by 946,000 to 12.8 million in total. That's up 43% year over year, adjusting for our exit from crypto last year. Nearly 40% of all new products in Q2 were opened by existing SoFi members. We also see that nearly 30% of new members open a second product in the first 30 days, demonstrating the immediate value of our one-stop shop strategy. We've doubled our member base and number of products in the past 2 years, and Q2 was the 20th consecutive quarter of greater than 30% growth. Our growth in members and products will drive our financial growth for years to come, and is the basis for our 3-year financial outlook shared at the end of 2023. All this growth is a direct result of our relentless focus on innovation. Because we offer products across 8 categories, compared to many fintechs that only offer 1 or 2, the magnitude of our innovation is not always obvious. As much as I'd love to share the full breadth of what we shipped in the quarter, I'll just cover a few of the highlights. I'll start with our financial services business, which drove 91% of our new product adds in the quarter. Our Invest offering is getting better every day. In fact, I don't know of any other self-directed product that offers alternative assets like private credit, private real estate, and private venture investing side by side with fractional shares, robo-funds, ETFs, and IPOs. Our innovations over the last year are starting to accelerate results, driving a 58% year-over-year increase in assets under management in our Invest business in Q2. And this was driven largely by net flows. We fully rolled out alternative assets and mutual funds, including interval funds from well-known financial leaders in KKR, Carlyle, Franklin Templeton, and ARK Venture Fund, which includes several leading private technology companies. Alternative assets generated 12% of all net flows during the second quarter. We brought the concept of one-click checkout to individual asset transfers, enabling our members to consolidate their assets the way they would like, and now we're seeing benefits from that innovation as well. We are now finalizing a turnkey way for companies going public to extend participation in their IPOs at scale to their customers, employees, and partners. With this new directed share program, people can open an account, enter an order, and fund it in minutes without fees, minimum balances, or speaking to anyone in order to participate in an IPO. Turning to SoFi Money, in the quarter, we launched Zelle, one of our most requested features and one element of our much larger money movement product pipeline. The innovations in our member business unit, which focuses on ensuring our products work better when used together, are reaching critical mass. For example, 3 million members have signed up for SoFi's broad-based rewards program. We're creating a rewards economy across our products, including rewards for using our app and other services, and we're expanding redemption options, including into stocks, cash for savings, and travel. For SoFi Plus, we achieved 1 million members. For people that are not familiar with SoFi Plus, it is our premium membership tier available to those who enable direct deposit. SoFi Plus includes our highest APY on banking balances, which today is up to 4.6%. It also includes up to 2x reward points, up to 3.3% cashback rewards on SoFi credit spending, discounts on personal loan rates, and much more. And I'm very excited to share that we've laid the foundation to provide more value in SoFi Plus, not only to direct deposit members, but also a monthly paid subscription product for those who prefer that option over direct deposit. We intend to test this new subscription-based option for SoFi Plus later this year. We're also driving iteration and learning to drive innovation in credit cards. We improved our acquisition capabilities and introduced a 10% cashback boost for SoFi Plus members that has shown positive results. And I'm excited to share that this week we'll also begin testing 2 new credit cards to better serve our members' needs. One card for cashback rewards on everyday high-spending categories, and one for members who need a no-frills card with no surprise fees. Turning to lending, we've launched new capabilities that position us for future growth, especially as the rate environment improves. In small and medium business, members can now apply for a loan at SoFi and get approved offers from lending partners. In home loans, we can now close our home equity products instead of brokering them out. This dramatically increases our potential for revenue per loan. Notably, we're now a principal in home equity loans and can offer members a lower cost of borrowing in these secured loans compared to higher rates in unsecured lending. And of course, our tech platform is a center of innovation as we add capabilities to our already comprehensive offering. We expanded our buy now, pay later product for post-purchase use. We added new wire capabilities and extended the AI-driven transactional fraud capabilities in our payment risk platform to non-processing partners. We also advanced the quality of our managed service in the cloud and introduced 3DS, which adds another layer of security to digital card transactions. These improvements ensure our modern, cloud-based platform will continue to serve the needs of brands, fintechs, and global financial institutions alike. Having world-class products is a necessary factor in becoming a top 10 financial institution, but it's not enough. We must also become a trusted household brand name. We measure this by our unaided brand awareness. Our world-class marketing team stands in a category of 1. Their amazing work has increased unaided brand awareness to the 7 to 9% range, which is up about 40% year over year and 4x since 2021. Our brand punches way above its weight as our team continues to make its footprint bigger than its foot. Now diving into our segment results. In financial services segment, we are seeing the continued benefits of structural advantages that drive our leading value proposition. We reported record segment revenue of $176 million, up 80% from $98 million in the year-ago quarter. Importantly, this drove contribution profit of $55 million compared to a loss of $4 million 1 year earlier. Financial services products grew $865,000 in the quarter, up 48% year over year, adjusting for our exit from crypto last year. Revenue per product grew 8% quarter over quarter and 29% year over year. We believe there's substantial upside to the monetization of our financial services products. SoFi Money achieved new records this quarter as ending deposits totaled $23 billion, with consumer deposits up $2.2 billion from the previous quarter. Account openings grew by 419,000, and 90% of our deposits remain tied to sticky direct deposit relationships. Debit spend also continues to increase at a rapid pace, up 129% year over year, and now annualizing at about $9 billion. Our credit card and invest businesses remain in investment mode with nearly $100 million in annualized losses, but we expect them to follow a similar path to money in achieving variable profit and contribution profit. In our credit card business, delinquency entry rates and roll rates improved by roughly 20% apiece from 2023 averages. Turning now to my fourth topic, our strong leadership across lending. We reported strong results despite our conservative posture, given a 500 basis point increase in benchmark rates over the past 2 years and continued macro uncertainty. Importantly, net interest income reached an all-time high of $279 million, or 82% of lending revenue versus 72% 1 year ago and 45% 2 years ago. Net interest income is cash revenue. Let me say that again. Net interest income is cash revenue, so 82% of our lending revenue is cash. Notably, discount rates and spreads were largely unchanged and in aggregate had a slight negative impact on lending revenue. Our personal loan originations reached a record of $4.2 billion while sticking to stringent underwriting standards as our team demonstrated its grit by consistently iterating on pricing and marketing throughout the quarter. Our home loan originations were their highest since Q1 of 2022, growing 24% quarter-over-quarter and 71% year-over-year, despite interest rates at their highest level in 10 quarters. On top of that, purchase home loan volume was our highest ever, growing 25% from Q1 2024 and nearly 100% year-over-year. Once rates come down, we expect to benefit from our expansion into 3 products in home lending: purchase loans, home equity loans, and the volume already generated by our financing business. Student loan originations grew 86% year-over-year. The team drove our strongest Q2 of origination volume in 3 years by iterating to drive continuous improvement throughout the quarter and into Q3 with private loan refinancing, which exemplifies our ability to respond to environmental factors to drive results. And my 5th topic, the tech platform segment is making good progress on its journey to become not only the AWS of fintech, but of financial services more broadly. We recorded segment revenue of $95 million, up 9% year-over-year, and contribution profit of $31 million, up 82% year-over-year at a 33% margin. This represents our 4th consecutive quarter of over 30% margin. Our customer wins have been more diverse, including but not limited to secure card and B2B partners. Our pipeline of interest remains robust and includes U.S. and international financial institutions, along with major consumer and commercial brands. As we have noted, we are pursuing enterprise partnerships with larger existing customer bases for more durable revenue opportunities. These partnerships take multiple quarters, not months, to win and have even longer integration cycles due to their size and complexity. In closing, the quarter was exceptional. We continue to demonstrate a record of strong, diversified growth, even in uncertain times. The performance of our leaders and the grittiness of our team was the best I've seen in my 7 years here. Suffice it to say, I cannot wait to see what we achieve in a better climate. Combining our high member growth and product innovation with lower benchmark rates, unemployment at 4 to 5%, stable inflation, and a stable economy, I could not be more confident in our ability to achieve our ambitions. With that, I'll turn it over to Chris for a deeper look at the results.
Thanks, Anthony. The second quarter was underscored by continued execution, profitability, and increased diversification. Strong evidence of how our differentiated business model drives SoFi's durability and long-term growth potential. I'm going to walk through key financial highlights in our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the second quarter of 2024 versus second quarter of 2023. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next month. For the quarter, we delivered record adjusted net revenue of $597 million, which grew 22% year-over-year. Adjusted EBITDA was $138 million at a 23% margin. This represented over 7 points of year-over-year margin improvement, demonstrating significant operating leverage. In fact, sales and marketing declined as a percentage of adjusted net revenue by 6 points relative to the year-ago quarter. We delivered our third quarter of GAAP profitability, with GAAP net income reaching $17.4 million, a $65 million improvement year-over-year, and GAAP EPS of 1 cent per share. Now on to the segment-level performance. In lending, we achieved adjusted net revenue of $339 million, with $198 million of contribution profit at a 58% margin. These results were driven by 20% year-over-year growth in net interest income, while non-interest income was down 38% as planned. Growth in net interest income was driven by a 40% year-over-year increase in average interest earning assets and a 27 basis point year-over-year increase in average yields. This resulted in an average net interest margin of 5.83% for the quarter, up 9 basis points year-over-year. In terms of non-interest income, Q2 originations grew 22% year-over-year to $5.3 billion and were driven by a record quarter in personal loan originations, which grew 12% year-over-year and 28% sequentially to $4.2 billion. Our student loans business saw origination volume grow 86% year over year, with a slight 2% decline sequentially to $737 million. Home loans grew by 71% year over year and 24% sequentially to $417 million. Our personal loan borrowers' weighted average income is $168,000, with a weighted average FICO score of 747. Our student loan borrowers' weighted average income is $137,000, with a weighted average FICO score of 764. In the second quarter, we sold portions of our personal loan and home loan portfolios totaling nearly $1.6 billion. In terms of the personal loan sales, we closed $1.1 billion of principal at a blended execution of 106.2%. These sales had similar structures to other recent personal loan sales, with cash proceeds in line with par or at a small premium to par, with the majority of the execution premium consisting of a contractual servicing fee that is capitalized. These deals included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would otherwise have if we held the loans. Our $381 million of home loan sales were sold at a blended execution of 101.9%. Additionally, we sold $69 million of late-stage delinquent personal loans in the quarter. We noted last quarter that we typically have not sold delinquent loans until such time that they are charged off. However, we've been able to generate positive incremental value in these sales relative to selling after they charge off, both from our improved recovery capabilities and by maintaining servicing. Finally, we executed $989 million of senior secured financing, which will show up on our detailed balance sheet as senior secured loans held for investment at amortized cost. These loans have a fixed-term structure and are secured against the underlying assets, therefore equivalent to investment-grade bonds if you were to do a securitization for the same pool of collateral. In addition, these loans are priced at market rates, which not only helps to diversify our balance sheet, but also provides an additional return above our cost of funding and a yield similar to the net interest margin of our loans, which are unsecured. Turning to credit performance, our on-balance sheet 90-day personal loan delinquency rate was 64 basis points in the quarter, a decrease from 72 basis points in Q1, which is evidence of surpassing a peak. Our personal loan annualized charge-off rate increased to 3.84% from 3.45% in Q1 2024, including the impact of asset sales, new originations, and the delinquency sale in the quarter. Had we not sold these late-stage delinquencies, we estimate that including recoveries between 90 and 120 days delinquent, we would have had an all-in annualized net charge-off for personal loans of approximately 5.4%. For our student loans, our on-balance sheet 90-day delinquency rate was 12 basis points versus 13 basis points last quarter, while our annualized loan charge-off rate was 64 basis points. That brings me to an important point. An in-depth look at cumulative net losses on several of our personal loan vintages and how this underscores comfort in our 7 to 8% maximum life of loan loss assumptions in line with our underwriting tolerance. As you can see on page 8 of our investor presentation, a loan vintage analysis indicates the following. Using our 2017 vintage as a starting point, as this is the last that approached 8% life of loan losses at 7.85%, you can see significant improvement in cumulative net losses at a given percentage of remaining unpaid principal for more recent 2022 and 2023 vintages. Specifically looking at the Q4 2022 vintage, soon after we made material cuts to credit, at roughly 40% of remaining unpaid principal, net cumulative losses of 5.02% are well below the 6.07% observed in the 2017 vintage at that same point of 40% remaining principal balance. In addition, you can see that more recent vintages are performing as well or better than the Q4 2022 loans at similar levels of remaining unpaid principal. This is critically important as this analysis and comparison gives us confidence that our loans will continue to perform in line to better than our tolerance. Furthermore, looking at page 9 in the investor presentation, you will notice that only 44% of unpaid principal remains from our Q1 2020 through Q1 2024 originations. Among the 56% of principal that has already been paid down, we've seen only 3% in net cumulative losses. For life-of-loan losses on this entire cohort of loans to reach 8% net cumulative losses, the remaining unpaid principal would need to charge off at a rate of 11%. Past vintages have performed meaningfully better after this point in the seasoning curve, further improving our confidence in achieving loss rates below 8%. Now turning to our fair value marks and key assumptions. Our personal loans are marked at 104.3%, 5 basis points higher quarter over quarter, with a negligible change in the discount rate. For our student loan portfolio, the fair value mark decreased by 17 basis points to 103.6%, while the discount rate rose by 10 basis points to 4.44% due to rising rates and a wider spread. Overall, sequential changes in spreads and discount rates had a negative impact on reported revenue. Moving on to financial services, where net revenue of $176 million increased 80% year over year, with new all-time high revenue for SoFi Money and our loan platform business, as well as continued contributions from SoFi Invest and Credit Card. Overall monetization continues to improve, with annualized revenue per product of $64, up nearly 29% year over year versus $50 in Q2 2023. This is driven by higher deposits and member spending levels in SoFi Money, greater assets under management and monetizable features in SoFi Invest, and robust growth within SoFi Credit Card spend. Net interest income of $139 million increased 87% year over year, which was primarily driven by growth in consumer deposits. Importantly, non-interest income grew 58% to $37 million in the quarter, which represents approximately $150 million in annualized revenue. This was driven by interchange growth of 67% year over year as a result of over $10 billion in total annualized spend, as well as our referrals from our loan platform business, which grew 66% versus the prior year period. Contribution profit reached $55 million at a 31% margin for the quarter, even as we continue to invest in innovation and new opportunities to rapidly grow this operating segment with attractive returns. Lastly, we reached 11 million financial services products in the quarter, which is up 39% year over year, with 865,000 new products in the quarter. We reached nearly 4.3 million products in SoFi Money, 2.3 million in SoFi Invest, and 3.9 million in Relay. Shifting to our tech platform segment, where we delivered net revenue of $95 million in the quarter, up 9% year over year and 1% sequentially. Revenue growth was driven by strong performance from new clients onboarded over the last 4 quarters, along with strong monetization of existing clients on our platform. Galileo accounts grew 23% year over year to 158 million. The segment delivered a contribution profit of $31 million, representing a 33% margin. We continue to leverage investments made in the segment as we continue to position tech platform for higher rates of diversified, durable growth going forward. As mentioned earlier, a strong pipeline of interest spans financial institutions along with major consumer and commercial brands, representing larger and more durable revenue opportunities and with longer sales and integration cycles due to the size and complexity. Shifting to our balance sheet, where we remain very well capitalized. Assets grew by $1.3 billion as a result of $2.1 billion of growth in loans and approximately $800 million decrease in cash equivalents, and investment securities. On the liability side, member deposits grew by $2.2 billion to $21 billion, while overall deposits increased to $23 billion. We also reduced our brokered deposits by $800 million as we continue to use our consumer deposits to replace higher cost parts of the funding stack, and we exited the quarter with $1.1 billion of warehouse debt drawn. Currently, there is a 213 basis point difference between the interest we pay on deposits and the interest we pay on warehouse lines, which translates to about $500 million in annualized interest expense savings, given the size of our deposit base. This difference also continues to support our net interest margin, underscoring the benefits of having the option of holding loans on balance sheet when advantageous and collecting net interest income. Overall, we expect to maintain a healthy net interest margin above 5% for the foreseeable future. and benefit from the continued mix toward deposit funding, along with our ability to sustain healthy deposit versus lending betas. In terms of our regulatory capital ratios, our total capital ratio of 16.8% decreased by approximately 50 basis points from 17.3% last quarter and remains comfortably above the regulatory minimum of 10.5%. Lastly, we grew book value to $5.9 billion and tangible book value by $92 million sequentially to $4.2 billion, with tangible book value per share at $3.92. Now on to guidance. Throughout the last 12 months, we have demonstrated the benefit of having a diversified, high-growth set of revenue streams, multiple cost-efficient sources of capital, a keen focus on underwriting high-quality credit, and a high degree of operating leverage as we scale the business. We expect those benefits to persist even in light of the macro backdrop. For Q3, we expect to deliver adjusted net revenue of $625 to $645 million, adjusted EBITDA of $160 to $165 million, GAAP net income of $40 to $45 million, and EPS of 4 cents per share. For the full year 2024, we now expect to deliver adjusted net revenue of $2.425 to $2.465 billion, which is $35 million higher than our prior guidance range of $2.39 to $2.43 billion. This implies 17 to 19% annual growth versus 15 to 17% previously. This guidance now assumes lending revenue will be at least 95% of 2023 levels, financial services will grow more than 80% year over year, and tech platform will grow mid to upper teens % year over year. While this is lower than our original 20% guidance for tech platform, we view this as transitory and still feel confident in our multi-year growth guidance for this business. We now expect to deliver adjusted EBITDA of $605 to $615 million, above our prior guidance of $590 to $600 million. This represents a 25% adjusted EBITDA margin. We now expect full-year GAAP net income of $175 to $185 million, above prior guidance of $165 to $175 million, and GAAP EPS of 9 to 10 cents per share, above prior guidance of 8 to 9 cents per share. We continue to expect growth in tangible book value of approximately $800 million to $1 billion and continue to expect to end the year with a total capital ratio north of 16%. We continue to expect to add at least 2.3 million new members in 2024, which represents 30% growth. Overall, we couldn't be more proud of our Q2 results. Having delivered $597 million of adjusted net revenue and $138 million of adjusted EBITDA, we continue to make great progress against our long-term growth objectives and remain very well capitalized to continue to pursue our ultimate goal of making SoFi a top financial institution. With that, let's begin the Q&A.
At this time, I would like to remind everyone that in order to ask a question, please press star followed by the number 1 on your telephone keypad. Please keep in mind we'll take
This
only
is a
one
good
question
earnings.
per
If you
person at
could
a
tap
time.
the like
Please
button and
rejoin
share
the
this
queue for any
video out,
additional questions.
more people will get to hear about
And the
this.
first
I
question
will
comes
also
from John
make
Hecht
this
from
a
Jefferies.
video
John,
later
your line
on,
is open. Please go ahead.
so it will rank on YouTube and
Morning,
optimize the
guys.
sound quality.
Thanks for
So
taking
look
my
out for that
questions,
shortly.
and appreciate all the incremental disclosure in the deck. The question is, I think you said that cumulative losses would have to go above 10%, I think to 11%, for you to kind of breach your 8% assumptions in your underwriting. What kind of scenario would that entail, in terms of like payment rates or delinquency rates, and just to kind of connect the dots there?
Yeah, sure, John. Thanks for the question. So like we said, credit's performing in line with expectations, and we remain extremely confident in our 7 to 8% life of loan loss assumption. Just to reiterate what I had mentioned in my prepared remarks, when looking at all originations from 2020 through Q1 of 2024, only 44% of those remain. Of the 56% that got paid down, we've experienced only 3% net cumulative losses. So in order to reach 8% cumulative losses on the entire pool,
the remaining 44% would need to charge off at 11%. So from where I sit, something would have to materially change in order to hit 8%, as prior vintages with similar levels of remaining UPB have never experienced losses even close to 11%. In addition to that, we ended up showing you vintage analyses that highlight how recent vintages, since making our credit cuts back in the second half of 2022, are performing materially better than the 2017 cohort, which was the last one to come even close to 8%. Furthermore, what gives us even more confidence is that the leading indicator for losses, which are our delinquencies, have started to turn the corner and we're really bending the curve. So in our personal loans business, we ended up surpassing a peak in Q1 on not only dollar principal, but also cumulative fair value adjustments and percentage UPB. So from a dollar principal perspective, we ended up having $96 million of 90 to 120-day delinquencies in the quarter versus 103 back in Q1. From a percentage UPB basis, those were at 64 basis points in the quarter versus 72 basis points in Q1. And then from a cumulative fair value adjustment basis, that was $79 million in Q2 versus $88 million in Q1. And what's even more important than that, these trends are continuing throughout the first several weeks of Q3.
The next question comes from Terry Ma from Barclays. Terry, your line is open. Please go ahead.
Hi, thank you. Good morning. So you show some pretty encouraging vintage charge-off metrics in slides 8 and 9, and it sounds like from your commentary, everything's kind of in line. But maybe just kind of reconcile your more conservative stance and maybe talk about what you need to see in the environment to maybe just grow a little bit again in the portfolio.
Thank you for the question. We're really encouraged by the trends we're seeing in credit, as Chris mentioned. We're really proud of the fact that we're able to achieve record revenue with 22% year-over-year growth, with lending barely growing. I would say the areas of incremental opportunity as we go into the back half of the year, home loans, really proud to see the growth rate year-over-year in home loans. Student loan refinancing, also a product that shouldn't be doing really well in this interest rate environment, also had strong growth. On the personal loan side, we're going to stay relatively conservative compared to our balance sheet ending assets there, primarily because we want to see how the year trends in terms of unemployment. There's a big number coming out on Friday. We're at 4.1%. A move to 4.2% could signal a recession. And so while there have been improvements, we're not changing our stance. We're able to achieve pretty strong growth year-over-year without getting too aggressive on the personal loan side. There are factors that could cause us to originate a lot more in personal loans. I will tell you, I see more near-term opportunity in home loans and student loan refinancing. But in personal loans, the thing that would cause us to be more aggressive in terms of the growth rate is if we have greater than expected sales. In addition to that, changes in benchmark rates. In addition to that, continued improvement in our credit trends if they start to accelerate better than we've already seen, which is quite positive. But all in all, we have a lot more growth. We could grow much faster if we wanted to, but we want to drive durable, diversified growth, and that was the reason why we took a stance in limiting our personal loan balances specifically. The other thing that could drive growth, which would be further diversification of the balance sheet, is home equity loans. We're now doing home equity loans as a principal as opposed to an agent. They're obviously secured lending and attractive rates, more attractive than personal loan rates. So there'll be a great emphasis on that. That could also drive better performance there. So a lot of opportunities as it relates to the lending business. We're taking a pretty conservative view purposely. I quite frankly don't feel like we're getting paid for the results we're delivering, so I'm not sure why we'd be overly aggressive at this point.
The next question is from Dan Dolev at Mizuho. Dan, please go ahead. Your line is open.
Hey guys, great results here. Really appreciate letting us asking a question. So, how are you, Anthony, Chris, how do you expect to keep growing financial services? I mean, obviously you've grown deposits so much. How do you expect to grow it given that you've grown interest income now? If you can talk a little bit about the near-term future. Thank you.
Thanks, Dan. Well, first, we did a really incredible job driving the diversification. The only way we're able to achieve record revenue is because our financial services segment had a record at $176 million, up 80% year-over-year. It was driven by product growth, as you know, up 47%. It was also driven by deposits, up 80%. that drives the net interest income. I think more interestingly is the growth opportunity we have in non-net interest income. We reported $37 million in that line item. It grew very nicely, 58% year over year. If you annualize the number, it's about $150 million. And there's a couple of drivers of that. First, continue to drive increased product growth. We had 47% growth in financial services products. That will be one driver of strong growth. The second is increased monetization or revenue per product. We saw strong growth in revenue per product in the mid-20s as well. What drives it going forward from here? Interchange was up 67% year over year. AUM was up 58% year over year. We'll see benefits in brokerage, not just from AUM growth, but also increased monetization per dollar of AUM, which is about half what we think the benchmark rate is. Continue driving home, auto, and life insurance, which we call SoFi Protect, and then our loan platform business. So it's a combination of those different monetization vehicles that will drive continued revenue per product, which we think has a significant upside after growing 29% already in this quarter. And then our product growth is something that's probably a lot more visible to everyone, which is up 47%. So dual-pronged dimensions of growth should continue to drive increased diversification there.
The next question comes from Kyle Peterson from Needham & Company. Kyle, your line is open. Please go ahead.
Great. Thanks, guys. Good morning. Thanks for taking the questions. Wanted to touch on deposits. Obviously, continue to see nice growth in the core base here with members. But how should we think about the growth outlook for deposits and kind of how that counterbalances with any ongoing runoff of some of the brokered funding?
Yeah, I'll let Chris talk about the sort of specific trends in the quarter. But as it relates to the broader macro picture, we're obviously entering an environment where rates are likely to go down in the future. And many people ask us, will you maintain a high rate? And the answer is we will maintain a high rate relative to our competition. We think we have a competitive advantage, given that we have such a big origination platform. The origination platform allows us to fund a higher APY than a lot of other competitors that don't have an origination platform. So the two businesses work in tandem. As rates go down, the value of our loans generally go up, all else equal, and so we can maintain a superior APY. That doesn't mean we may not change it. It just means it will be superior to drive our differentiated value proposition and leverage our competitive advantage. As it relates to deposits, more specifically, rate is one element of our differentiation. The other elements of differentiation start with no fees. We do not charge. We don't require minimum balances to get our services. You do get a higher APY if you do direct deposit or you do an average monthly deposit of a certain amount. As we mentioned in the call, we'll actually launch SoFi Plus, which will give you that higher rate for a fee per month, which will be credit attractive relative to the amount of interest you could gain when you pay that fee. In addition to that, we have the ability to do person-to-person payments to an email address or a phone number. We recently launched Zelle, which is very unique among the fintechs, which is a highly requested product. In addition to that, we provide seamless capabilities into our brokerage business and money movement more broadly. So the APY is one important element of driving deposits, but it's the broader value proposition that we offer that we think will continue to allow us to drive strong deposit growth on the back of strong member growth in money.
Yeah, and what I would add to that is we've consistently said that we were going to add over $2 billion of member deposits each quarter. We certainly did that in Q1. We did it again in Q2 with $2.2 billion of net new deposits from a member perspective. We did pay down about $800 million of brokered CDs as they had higher costs relative to our member deposits. Right now, we are about just north of 80% deposit funded. Going forward, we believe the optimal mix is consistent with our prior guidance at about 80 to 90%. We still have about $1.1 billion of warehouse debt that's outstanding and nearly $2 billion of brokered deposits. So we're going to continue to optimize funding sources and lower our overall costs.
The next question comes from Reggie Smith from JP Morgan. Reggie, please go ahead. Your line is open.
Hey, good morning, and thanks for taking the question. I appreciate the disclosure on the loss curves, and I hope you guys continue to publish that. Kind of similar thing. I was curious, and I think I asked about this last quarter, about the credit card program or business. And I look at, the fact that you've got 4 million money users and, almost 4 million relay users, and only, less than 300,000 credit card accounts. And it would seem that there's an opportunity to really be very targeted and slice and find really prime credits within your customer base. Can you talk a little bit about that? Maybe, am I oversimplifying that? It just seems like that business could be a lot bigger than it is. But maybe I just don't understand how that ramps up. So maybe a little color on how that business grows and some of the things that keep it from growing faster than it would appear to have the opportunity to grow.
Reggie, thank you for the question on credit card. I would start by saying, we have a pretty diversified portfolio of products. Our goal is to drive a series of S-curves of growth across the products so that we drive strong, durable, diversified compounding growth for years, which means we'll invest in some businesses faster and quicker than others. I often say internally, we have some startup businesses, we have some Series A businesses, some late-stage growth businesses, and some mature growth businesses. Credit card is one of those early-stage businesses where we want to make sure that we get the marketing, the product market fit correct, the credit correct, and really the overall unit economics of our credit card on a per-account basis correct. We've spent the last 18 months working our butt on that, and we feel like we have the right formula. I know we have the right team. We did change the team about a year and a half ago, bringing in someone that's actually built this business from scratch before, in addition to running businesses. So we have a very positive long-term outlook for credit card and want to contribute to our business. I often say businesses like credit card and brokerage by themselves someday could be bigger than SoFi is in total today. There are companies that are very big that are just in the credit card business and just in the brokerage business. Today, those are small for us and we're investing aggressively. We pointed out the fact that the brokerage business and the credit card business combined are annualizing a loss of $100 million. So what are the changes we're making in credit cards specifically? We'll launch 2 new cards. We'll be testing them slowly. One is an everyday card where people get a much higher percentage reward on categories like food or things that are used every day. The second card is more of a no frills, no surprises card for people that are in our ecosystem that are members, but they have thin credit files, not because they have low credit, they just have very little credit because they may be a new professional, in addition to our existing card. Not only will we launch 2 more cards, but we'll make those cards work better with our other products. So if you're a SoFi Plus member, your rewards will be boosted because of that relationship between SoFi Plus and credit card. So we can start to benefit from not just targeting our members, but giving our members more value for using more than one product, and you'll see us continue to do that over time. But in credit card today, we're going to continue to move relatively slowly and not step on the gas too hard, because this is a business you can lose a lot of money, and you can lose it every day. It's unlike a loan where you give somebody a fixed amount. In credit card, you have lines that are quite big, and they can be utilized in nefarious ways and drive really high losses. So we'll continue to make sure we approach this prudently, but we are stepping on the gas a little bit more than we have in the past.
The next question comes from Jeff Adelson from Morgan Stanley. Jeff, your line is open. Please go ahead.
Hey, guys. Thanks for taking my questions this morning. I just wanted to circle back on the lending growth. I know you're still sort of maintaining a more cautious stance on origination there. You did a little bit better than we thought on originations this quarter, and your lending revenue growth looks like it's still up 5% year over year. So I guess just, are you seeing better opportunities coming in the door, and does it have anything maybe to do with more certainty around the forward look with rate cuts? I know you're talking about potential increase in unemployment rate from here as well. So just trying to square all of that. And then Chris, also just in terms of, the bending of the curve comments on credit, just wondering when you think that might translate into the, all-in 5.4% charge-off rate starting to come in lower each quarter as well. Thanks, guys.
So in the lending business overall, our first objective is to make sure we continue to diversify the lending business relative to the total company. Less capital, less risky businesses get valued much higher, and we don't want to have an over-dependence on a high capital, high risk business. And this year, the macroeconomic environment accelerated our diversification, and it's worked out quite well. We also want to diversify within lending. As I mentioned, home equity loans is diversification into secured lending, which will be our second secured product. In addition to that, student loan refinancing is our oldest and used to be biggest product. We think is starting to come into a period where it can do quite well, and that's also diversification relative to unsecured personal loans. And then across home loan refinancing is also a vehicle. As we go through the year, I think it's important just to understand we're trying to manage to the overall growth of the company. We have so much resources we want to allocate, and we're allocating it to drive that outcome of diversified, less risky, less capital-intensive businesses. If we wanted to grow personal loans more, we would have to allocate more capital to it. Why? We have to drive marketing that drives the top of the funnel that then drives conversion. Those loans don't just happen because we decide to actually underwrite more. We actually have to spend money to underwrite more. Right now, we're choosing to spend that money in different areas that don't drive as much revenue. But despite that trade-off, we're still driving 22% year-over-year revenue growth and a record despite barely growing personal loans. So it's a very conscious effort to diversify in a number of different ways. Diversification means you reallocate resources other places. If we reallocated to personal loans, we would not achieve our diversification. Now, what happened in the quarter? Our marketing costs were more efficient. The money we were spending was driving more demand than otherwise would have demanded or otherwise would have driven, and we took advantage of the higher unit economics to drive more volume against a set amount of resources in that area. We could be more aggressive if we choose to allocate more resources to lending. That could happen because we have upside in other businesses. That could happen because the marketing efficiency is greater than we anticipated, or the credit is performing better, or we sell more loans. And so it's not because the growth isn't there. It's how we're choosing to allocate the capital in this environment relative to our broader goals. And I'll let Chris talk about the specific question you had on the losses.
Yeah, and in terms of when some of these early DQ trends will start to show up in the NCOs, we're sticking with our overall guidance of being confident in the 7 to 8% life of loan losses, and we aren't guiding to NCO rates specifically. Reason for that is quite simple. The NCO rate is very lumpy. It's a function of a number of different factors, such as originations in the period, sales in the period, and most importantly, the average age or how much UPB remains on the portfolio, which can be driven by a number of things. So overall, we feel really confident in our life of loan loss expectation of 7 to 8%, but we're not guiding to NCOs because they're so lumpy.
Final test question today comes from Peter Christiansen from Citigroup. Peter, your line is open. Please go ahead.
Thank you. Thanks for the question here. Good morning. Nice trends. I was wondering if you could talk about the appetite for future asset sales, either demand for it, but also your risk transfer strategy kind of going forward from here, given that you are seeing improvements, credit improvements in your portfolio, particularly in the personal loan portfolio. Just how are you thinking about risk transfer from here, and if there's further opportunities to de-risk the portfolio? Thank you.
Yep, absolutely. So overall, we're seeing continued strong demand from credit buyers. We've done $3.3 billion in sales over the course of the last 3 quarters in our personal loan business and 4.7 in aggregate. That's predominantly driven by the shape of the interest rate curve with lower expectations in the second half of this year as well as the next several years. So we have very attractive yielding assets with very strong credit profiles and low risk for buyers. Essentially, buyers are looking into lock-in purchases and programs ahead of any interest rate cuts. In addition to that, we have a really strong balance sheet. We are able to offer flexible deal structures to meet buyers where they need to be. We are one of the few participants that can sell in size. It allows investors to put money to work. It allows buyers to have one buyer versus many, and it allows them to have a long-term partner versus doing bespoke one-off transactions that require a ton of work. Buyers want stability of asset generation. So looking forward, we expect to see continued strong demand from credit buyers. In a declining rate environment, we would expect that demand only to increase as those buyers would have lower cost of leverage. And again, we're one of the few folks that have a sizable balance sheet who can do that.
We'll take one more question, operator, and then I'll close with comments.
The final question comes from Tim Switzer from Stifel. Tim, your line is open. Please go ahead.
Hey, good morning. Thank you for taking my question. How would a return to a lower rate environment kind of change the ROE math you guys have talked about on choosing to retain loans versus selling? Do you believe it could strengthen demand at all in the secondary market and kind of change your balance sheet management at all?
I would say generally lower rates are going to make the loans more attractive to those without origination platforms that have assets they need to deploy. Our weighted average coupon is quite high, and that ROE becomes more attractive as rate environment declines and there's less places for them to find that type of yield. We've seen that in the past be the case. So we would anticipate more demand. We'd have to manage it relative to our production and our own financial goals. But I do believe the demand would increase and the terms would be more favorable and the values also, would be attractive. We have to wait and see that happen, but that's what we've seen in the past. Great. In closing, I want to express my gratitude to our team. Q2 was the most rewarding quarter and, dare I say, the most fun that I've had in some time at SoFi. What made it special and fun was that we challenged ourselves to be better in areas that are the most difficult in the current environment that aren't supposed to do well in this environment, such as home loans and student loan refinancing that had volume increases of 71% and 87% year over year. The team found a way to be better continuously throughout the entire quarter, not just each month or each week, but literally each day, finishing strong all the way through the tape when, quite frankly, the only reason was because we pushed ourselves to keep iterating. It was also fun because we made hard resource allocation decisions in 2023 that meant doing less than we wanted to in areas with great growth potential, such as invest in credit card, where we are now seeing promising results. Our invest business is accelerating with AUM up 58% on the back of a lot of hard work and only a couple of important areas and a testament that less can be more. In our credit card business, the immediate gains from all of our iteration aren't so large today, but with time and scale, they will be massive and well worth the patience. If you can't tell by now, I feel great. To put it bluntly, I do not know of any financial services company or fintech that has transformed their business to be less risky, less capital intensive, while still driving strong revenue growth, 40+% user growth, all while massively increasing profitability and still funding a rapid pace of innovation. When you take a step back, it's inspiring to see. We hit record revenue of nearly $600 million with 22% year-over-year growth, despite lending barely growing. We did that because we achieved record revenue in our financial services segment at $176 million, up 80% year-over-year on the back of 47% year-over-year growth in products, 80% year-over-year growth in deposits, 58% year-over-year growth in AUM, and 67% year-over-year growth in interchange. In lending, we grew home loan volume 71% year-over-year, student loan refinancing volume 87% year-over-year, and personal loan volume 12% year-over-year, while delinquencies declined on an absolute and percentage basis for PL, and we provided vintage analysis that clearly shows why we are comfortable with personal loan, life of loan loss forecasts. And finally, we grew EBITDA 80% year-over-year. I love what we have built, but more than ever, I love the people we are building it with and the gritty culture we have created. Hard is not for everyone, but for me and those who stay at SoFi, it fits just fine. Thank you for your interest in SoFi, and talk to you next quarter.
There we go. SoFi earnings. Thank you very much for joining me. Now, this is what we're going to do. I'm going to send you now all to the extra channel in a couple of seconds. Automatically, it will go there. I've also given you the link in the chat. It's also pinned to the top if you want to join us. So behind the scenes conversation here in the extra channel before the opening bell show starts, okay? So what I'm going to do now is end this stream. I'm now going to optimize the audio quality and cut before and after when I was speaking before and when I'm speaking now, and post this as a video. Now, if you are a SoFi investor, I hope to make this video rank by itself. It's a good earnings. I'm bullish on it today. Like what I've heard today, I've been very bearish in the past. The CEO has made a lot of mistakes, has said a lot of rubbish. But today that was much, much better. The performance of the company is improving. No question about that. And I want to put a bullish earnings out. So when you see that, if you watch it, it will promote it, and it'll start to trend. We hope to be number one for SoFi stock, the search term on Google and YouTube. We're not at the moment, but I hope to by the end of the day. So very, very quickly, I'm going to make a couple of quick reaction videos now, and then I'm going to end this stream, send you to the extra channel, and then I'm going to come back with the opening bell. It's advertised at 9 o'clock. Which is an hour from now. I hope to be as early as possible. I'm never late. I'm always going to be earlier than that, but I never know how long these earnings are going to last. So let me just make my reaction, a couple of reaction videos. So SoFi at end. Here we go. SoFi earnings, we've just covered the earnings, and a very interesting one it was too. I've always been quite bearish on the CEO. He's talked rubbish in the past. There's complete misinformation and self-promoting his stock, which is fine, but when it's manipulative, it's not good in my book. However, today was much, much better, and it was a very, very good earnings. It wasn't excellent, but it was a very, very good earnings. And I also would like to mention as well, give a shout out to SoFi for this. I was very, very impressed by this. Let me just share with you on the screen what I'm talking about. I put a post out on X just some moments ago. You might want to go and comment. First time ever. SoFi, great earnings. Congratulations to SoFi. This is what's the first. Also, huge respect as the very first earnings to announce at the advertised time, they would be another 2 minutes. I've covered hundreds of earnings for the last 3 years. Most people go late with disrespect to their investors. Never understood it. This company today said they will be 2 minutes late. I've never, ever experienced that as well. All earnings go late and never a word to the investors. I've covered hundreds of earnings. Many, many thanks. I think that's very, very important. It's got nothing to do with the stock, but it shows a good management and good understanding and respect to their investors. So I like that. So big shout out to SoFi. Now I'm just about to post the edited version. When I say edited, I just optimize the sound quality and cut me out talking before and after to give you a much better viewing experience. If you want SoFi to do well and rank it as a bullish earnings, perhaps when you see the video come out, share it, like it, leave a comment. I will reply to all of my members. That would help enormously. Click above my head for all the links down below in the description, over here and over here. I'll put more, and I'll put the link as well for the video itself when it comes out. And down here, I'll put the playlist for SoFi. SoFi, I've gone from bearish to more bullish today. It's room for more investigation. Congratulations and awesome total respect for respecting your investors with announcing that you would be late. I love that. First time ever. Thank you. Okay, that's that. What else? Let me come out of here a minute. Let me just do that. Right. Fed report, Jerome Powell, FOMC. We're going to be reporting live tomorrow. Join us on the show for the FOMC report. Are we going to get rate cuts? I predict no. What we do want to hear, though, is a very dovish position and that we're going to get rate cuts. We'd like to hear there are more than one. However, it's not in Jerome Powell's style and mantra to actually report or even suggest that. He likes to keep people waiting as long as possible, doesn't want to create a surge in the stock market. But tomorrow will be very, very interesting. So join us for the FOMC report. You might want to join us tonight as well, after hours, for the Microsoft earnings. That is kind of more important, if you like. We want to see AI come in and earn money for Microsoft. Google didn't pull it off because people are impatient. It will do, but people were impatient and they dropped the stock. Let's see what Microsoft can do. It's constructed rather differently. But join us for the FOMC report. You cannot miss that one. We'll cover it live, the whole thing live, followed by debate afterwards and stock market reaction. Click above my head for the link down below in the description. I'll also pin it to the comments. Over here, I'll post the event as well. FOMC report, and down here, I'll put another playlist I think you'll find useful. Until then, as always, take care of yourselves and each other. All right, and MSFT. Microsoft earnings tonight. Join us. You cannot miss it. This will set the market going into, of course, the FOMC report the following afternoon. We're covering both of these live. You cannot afford to miss it. Microsoft is measured differently than Google, and what we're looking for is to see that AI has started to return a profit to Microsoft. Will it? Well, if it does beat tonight, many think that there could be a surprise on the cards. If it does, get ready for the market to explode, because we've seen the stocks rotation into small caps, rubbishy stocks that don't make any money, dumping the big caps. But don't worry, those investors are waiting for an excuse to come back. Many thought it was the top, but if we do beat on earnings, and it's a good beat, remember, Microsoft, Google, Nvidia, Amazon, it's all priced for perfection. But if we get a blow off the top, and it's really quite exciting, then the markets are going to explode. Join us tonight for the live earnings, and then tomorrow for the FOMC report. Can you really afford to miss it? Click above my head for Microsoft. Down below in the description, I'll also post it in the links, the comments rather. Here I'll put the event itself, and down here I'll put more videos that you'll find useful. Join us. Can you afford to miss it? Right, Microsoft. Okay. SoFi. Then shorts. All right. Okay. SoFi, a great earnings. Not amazing, but great. It's gone from bearish for me to more bullish. Room for further investigation. I like what the CEO had to say today, and I like the way they're growing their business. I like it. We've just covered the earnings. You might want to watch it. A related video down here, up here. No, that's wrong. Down here. The related video. If you want to go and check out the earnings, I've just optimized the audio quality to improve the experience and upgraded it to 4K. Go and check it out. You might find it interesting. SoFi, and MSFT, Microsoft. Microsoft earnings tonight. Is it going to be a blow off the top? Are we going to get excited? Microsoft reports differently than Google. Very different business, but similar. You understand what I'm saying? People didn't like waiting around for Google's profits. Tonight, we could get Microsoft report slightly differently and surprise people. Many people think this could happen. We've had rotation moving out with the mega caps, but they'll be back. Join us tonight for the earnings. If Microsoft surprises with a really exceptional earnings, the markets will explode. Go down here for the related video, up here for the chart. You can see and join us for Microsoft earnings tonight. You cannot afford to miss it. Okay. FOMC report, Jerome Powell in the house. He might not have many more of these left. Donald Trump says he's going to fire him when he comes into office. Let's see what he does. We know he wants to leave a legacy, but it's not about him, of course. It's about you, the investor. Tonight, we're going to cover the Microsoft earnings. That's important. But tomorrow, join us live for the FOMC report. Are we going to get a rate cut? No. Are we going to hear how many rate cuts we're going to get? No, Jerome Powell never does that. How do I know? I've covered the last 3 years of FOMC reports. What we do want to hear, though, is a dovish response that the committee are happy and likely to reduce in September. That's as good as you're going to get. We're not going to get rate cuts. That would spook the market, but we are going to get, hopefully, an indication of a rate cut in September. What I'm looking for is the potential, read between the lines, that he's going to drop it by 0.5%. That's what I want. That's when the market will rally. Join us for the FOMC report. It's one you cannot afford to miss. Okay. Now I need to get off. We've got 15 minutes before the bell. We're going to close the show down right now. I will see you back very, very shortly. Now, I've given everybody the link for the show. Hit the extra channel so you can be in here. You'll see the markets. You'll hear my reactions. You'll hear what's going on as I'm editing these videos out. It will take you there automatically. Join me there now for that. I'll be back very, very shortly, as quick as I can. I'm advertised for 45 minutes from now. I should be earlier. I will be earlier. I always am. So go into the extra channel right now. You can keep in touch with the family and the community, discuss what's going on the bell, and I'll be back as soon as possible. Of course, I can't be here for the ring of the bell because I have to put out the video I've just recorded for SoFi and everything else. See you back in a minute. I'll be as quick as I can. Don't go anywhere. Now join me on the extra channel. Until then, as always, take care of yourselves